Why is gold moving when the petrodollar is dying? That's the question nobody is asking correctly, and the answer reveals exactly where your retirement savings should be positioned right now, before the obvious move happens. I've spent 40 years studying how monetary systems transition. The petrodollar system is not being dismantled from the outside by BRICS or China or Saudi Arabia accepting yuan. Those are symptoms. The real story? The system is dissolving from the inside, and the reason tells you precisely where capital is moving next, including into a place 90 miles from Florida that most American investors haven't thought about seriously since 1962. If you have money in a 401k, in bonds, or in savings you plan to draw on in retirement, this transition is the most important structural story of the next decade. The investors who understand the mechanism will be positioned very differently from those who do not. Here's what most financial commentary gets wrong. When people say the petrodollar is ending, they point to external challenges: BRICS trading in local currencies, China negotiating yuan oil contracts, Russia and India settling energy outside the dollar. These are real, but they're consequences, not the cause. The cause is something nobody is stating directly enough. The petrodollar system was built on a 1974 bargain. Following the oil shock and Bretton Woods collapse, the United States reached an agreement with Saudi Arabia. The Saudis would price oil exclusively in dollars and recycle those surpluses into U.S. Treasury bonds. In exchange, America would provide military protection and security guarantees. The other Gulf producers followed. This created structural, non-negotiable global demand for U.S. dollars. Every country that needed oil needed to hold dollars, and the most productive place to hold dollars was U.S. government debt. That arrangement funded American deficits for 50 years. It gave the United States an exorbitant privilege, borrowing cheaply in its own currency at scale without the inflation consequences that would normally follow. Now here's what changed. The United States is now the world's largest oil and gas producer. It surpassed both Saudi Arabia and Russia. It's a net energy exporter. The original 1974 premise that America needed Saudi Arabia to stabilize oil markets and ensure supply no longer holds. The enforcement incentive has shifted. The U.S. no longer has the same strategic imperative to maintain the Hormuz corridor, to garrison the Gulf, to subordinate its foreign policy to Middle Eastern energy security. The arithmetic of its energy position has changed fundamentally. When the enforcement incentive weakens, the system it was built to maintain begins to loosen. Not overnight, but the direction is established. What you're watching in the Middle East right now, the tolerance for instability, the strategic repositioning toward the Western Hemisphere, the calculated distance from Hormuz, is a system in transition behaving exactly as systems in transition behave. Let me explain what this means for your portfolio. The petrodollar recycling mechanism was the primary engine of demand for U.S. Treasury bonds for 50 years. Foreign central banks and oil-producing nations held dollars because they needed them and parked those dollars in treasuries. That demand kept treasury yields lower than they would otherwise have been. Lower yields meant lower borrowing costs across the entire economy. When that structural demand weakens, which it already is measurably, yields have to rise to attract remaining buyers. And when yields rise on a federal debt load of nearly $40 trillion, the annual cost of servicing that debt increases rapidly. The Congressional Budget Office projects interest payments will exceed the defense budget within this decade. That's arithmetic, not theory. For investors with significant bond holdings, many people in their 50s and 60s hold substantial fixed income in retirement accounts, often without realizing it. This is the central risk. When yields rise, bond prices fall. A bond portfolio that appeared conservative under low yield conditions looks very different when yields are rising structurally, not cyclically. The difference matters. A cyclical yield increase happens when the Fed raises rates to cool inflation, then cuts them when the economy slows. I've seen many of those. Those are navigable. The structural yield increase is different. It happens when the underlying demand base for the asset is permanently smaller. When the petrodollar mechanism was the marginal buyer for decades, and that mechanism is contracting, you don't get relief by waiting for Fed cuts. The buyer base has shrunk. The yield adjusts to compensate. This is the environment we're entering. Now let me turn to the part I believe is genuinely underappreciated. The United States is executing a strategic pivot that is the most significant geographic reorientation of American economic and military posture in generations. The direction is inward and southward, toward the Western Hemisphere, toward closer supply chains, toward resource relationships that don't run through contested corridors 12,000 miles from home. You can see this in Venezuela, the pressure on Maduro, the opening of energy investment conversations, the recognition that Venezuelan heavy crude is exactly what Gulf Coast refineries were built to process. Venezuela has the largest proven oil reserves in the world. Under normalized relations, that resource base becomes a strategic asset that reduces Middle Eastern dependence entirely. But Venezuela is only the beginning. There's a place 90 miles from Florida that holds deposits of the exact minerals determining which nations lead the next 50 years of technological and military capability. Cuba. Let me be precise about the economics. The modern economy runs on critical minerals: cobalt for battery cathodes, nickel for EV drivetrains, copper for every data center, EV charging network, renewable installation, rare earths for permanent magnets in wind turbines, electric motors, advanced weapons. These are the physical inputs the AI economy, electrification economy, and defense technology economy require in massive quantities. Cuba is the fifth largest cobalt producer on Earth. It holds some of the largest nickel deposits in the Western Hemisphere, significant copper and rare earth resources, and virtually none developed to productive capacity because the country has been cut off from international capital markets and modern mining investment for 60 years. Consider the strategic context. China controls approximately 60% of global rare earth processing. It secured cobalt through Congo investments, nickel in Indonesia and the Philippines. The competition for critical mineral supply chains is the defining resource contest of this decade. Not oil, which America produces abundantly, but the inputs to technologies determining economic and military power for the next half-century. A normalized Cuba with American capital flowing into its underdeveloped minerals sector, with U.S. companies building port infrastructure and processing facilities decades of embargo prevented, is not a geopolitical curiosity. It's a strategic asset in a competition China has been winning for 20 years. The sequence of recent developments is worth noting: pressure on Venezuela, Cuba's primary energy supplier; financial isolation of Iran, a significant economic supporter of Havana. These moves systematically remove external support structures, sustaining Cuba's independence from the international financial system. I'm not predicting timing or specific form. What I'm saying is the strategic logic of the Western Hemisphere pivot, the critical mineral competition with China, and Cuba's resource endowment point in a coherent direction. The historical pattern: Venezuela's oil attracted capital before political clarity, Eastern European infrastructure investment before the Berlin Wall fell, suggests patient positioning before the obvious moment is where significant returns were captured. Let me bring this back to your financial position. The transition from a dollar system anchored by petrodollar recycling to one anchored by domestic energy, Western Hemisphere resources, and reconfigured supply chains is a transition in where value is created and stored. Dollar-denominated fixed income, treasury bonds, investment-grade corporates, any long-duration fixed-rate instrument faces structural headwinds as the demand base that kept yields suppressed contracts. I'm not saying these go to zero. Their expected returns over the next decade look meaningfully worse than historical averages, and their risk profile is higher than most retirement models assume. The dollar will face sustained pressure, not collapse. It remains the dominant reserve currency. But gradual, persistent devaluation against hard assets is the most likely path as structural support from the petrodollar system weakens. Hard assets benefit from exactly this environment. When Bretton Woods collapsed in 1971 and the dollar was severed from gold convertibility, gold went from $35 per ounce to over $800 by 1980, not because the world ended, because the monetary anchor suppressing its price was removed. The petrodollar system served as a secondary anchor. As that loosens, the same dynamic applies. Mining equities, particularly those with cobalt, nickel, copper, rare earth exposure, are at an early stage of what I expect to be multi-year repricing. The demand trajectory is not speculative. It's the physical requirement of electrification and AI build-out. Supply response takes years. That gap between demand certainty and supply constraint is where patient investors have historically found significant returns. Infrastructure and construction exposure to the Western Hemisphere, the companies building ports, processing facilities, energy networks of a reshored American supply chain, represents longer duration opportunity. These are not trades. They're positions in a structural reorientation of where American capital is deployed. Every major monetary transition in history has produced wealth transfer, not because some are predatory and others victims, because different assets hold value differently across transitions. When Bretton Woods ended in 1971, investors who understood the dollar's purchasing power would decline, and hard assets would reprice built generational wealth. When the petrodollar system was constructed in 1974, investors who understood it would create persistent demand for U.S. financial assets and suppress commodity prices adjusted accordingly. We're at a comparable inflection point. The system that shaped the financial landscape for 50 years is in structural transition. The transition takes years, not weeks. But the direction is clear to those who look at the mechanism underneath headlines. The investors who adjust early, who move out of assets most exposed and into assets most likely to appreciate, hard assets, critical mineral exposure, Western Hemisphere resource plays, domestic energy, will look back on this period the way gold holders look back on 1971. Not as a crisis they survived, but as an opportunity they recognized.